Here is a table for the marginal costing technique and the absorption costing technique. Here in the table for the marginal costing technique, we have the sales, opening stock, the production, closing stock. Here we have the sales, the opening stock is not given, the production and the closing stock. When you add, so you have to add opening stock plus production minus closing to get this value. When you get your value, you deduct it from your sales. You derive at your contribution margin. Just for period 2 now, the opening stock is not given, but the production is given and the closing stock is given. So opening stock plus production minus closing stock, you derive your answer. That you deduct it from your sales, you get your contribution margin. The same thing applies to this place. Then less period costs. Period costs are your expenses, which are your fixed production overhead and your administration overhead. Your fixed production overhead has been given in the question, and the administration overhead is also given in the question. The fixed overhead is 1 naira. 1 naira, which is the fixed unit cost, times the 30,000 normal level activity. Let's divert a bit. Remember our calculation here. How we got 1 naira to do our fixed cost. So this 1 naira as the fixed cost. 1 naira times your level of activity, which is 30,000. That is how the reduction, the fixed production as I had derived. So you have to add the expenses and deduct it from your marginal contribution margin to ascertain your net profit. The same thing applies to here. Then back to the absorption costing technique. We have our sales, opening stock, total cost. Yeah. So in marginal costing, it is called production, but in absorption costing technique, it is called your total cost. So we have your opening stock plus the total cost minus your closing stock. You arrive at this value. Then you deduct it from your sales. Then you derive your gross profit. In absorption costing technique, we call it gross profit, but in marginal costing technique, we call it contribution margin. Then you apply the same concept for the year 2 and for year 3 or period 3. Here now, the opening stock is not given, but we are given the total cost and your closing stock. Like I said, opening stock was total cost or your production less your closing stock. You arrive at this value. They deduct it from your sales to arrive at your gross profit. After that, then you deduct your expenses. The only expenses that should be deducted from the gross profit is your administration overhead, which is being given in the question, which is 25,000 naira. So you deduct it from your gross profit to ascertain your net profit. Now, one of the concepts of this costing technique is for us to know which of the technique to use, either the marginal or the absorption. Now let's take a look at this now. Let's compare contrast. From the look of things now, for the marginal costing technique now, for your contribution margin, or rather for your net profit here, the highest net profit here is 116,000 naira, which is for year 3. Why the highest net profit when the absorption costing technique is adopted? The highest value is 242,000 naira. So it simply means that from the look of things, adopting absorption costing technique is more profitable.